Did you know that Starlight Investments is making a significant move in the Canadian real estate market with a massive $750 million fund? What does this mean for multifamily real estate investors across the country? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a major development for the Canadian multifamily real estate sector, Starlight Investments has announced the launch of a $750 million investment fund aimed at acquiring purpose-built multifamily rental properties in the nation's largest urban markets. This move is set to have a substantial impact on the real estate landscape, particularly in cities like Toronto and Vancouver, where demand for rental housing continues to rise. According to CoStar News, this fund is a joint venture with CIBC Investment Management, which is contributing $415 million in equity to the initiative. Starlight Investments, headquartered in Toronto, is well positioned to leverage this partnership to expand its portfolio and capitalize on the growing need for rental accommodations in urban centers. The founder and chief executive officer of Starlight Investments, Daniel Drimmer, has been instrumental in steering the company towards this ambitious goal. With a focus on acquiring high-quality, purpose-built rental properties, the fund is expected to attract significant interest from investors looking to tap into the robust multifamily market in Canada. This strategic initiative not only highlights the confidence investors have in the Canadian real estate market, but also underscores the ongoing demand for rental housing in major cities. As urbanization trends continue to shape the housing landscape, investments like these are crucial to meeting the needs of a growing population. For multifamily real estate investors, this development presents both opportunities and challenges. On one hand, the influx of capital into the market could drive competition for properties, potentially leading to higher valuations. On the other hand, the increased investment in rental properties could help stabilize the market and provide more rental options for tenants. As always, it's important for investors to stay informed and adaptable in this ever-evolving market. With Starlight's new fund poised to make a significant impact, now is the time to consider how these changes might affect your investment strategy and explore new opportunities for growth. In a noteworthy update for the Canadian real estate market, the Canada Mortgage and Housing Corporation, or CMHC, has announced changes to its multi-unit mortgage loan insurance program. As reported by Nadeem Khashoggi from Greenbirch Capital, these updates are poised to have significant implications for multifamily real estate investors across Canada. One of the key changes that took effect on June 4th is the removal of restrictions on the use of refinance proceeds. This means that property owners now have greater flexibility, as any lender can be in place prior to refinancing, and there are no longer limitations on what refinance proceeds can be used for. This change is expected to improve profit margins for those renovating and refinancing multifamily properties, allowing capital to flow more freely back into the sector. Additionally, the MLI Select program's scoring for energy efficiency will see an adjustment starting June 19th. The number of points obtainable through this social outcome will be reduced, with maximum benefits reserved for projects that offer some level of affordability. This reflects CMHC's aim to promote affordable housing solutions. Another significant update is the extension of the maximum amortization period for the MLI Standard Market Program, set to take effect on June 19th. The maximum amortization for new construction projects will increase from 40 years to 50 years. This change will allow for higher leverage and lower mortgage payments, potentially making the standard program more attractive for new construction projects. Furthermore, the approved correspondent program is undergoing changes. Effective September 3rd, only approved lenders will be permitted to submit multi-unit applications directly to CMHC. This will require brokers and borrowers to select a lender prior to obtaining CMHC approval, providing greater certainty in the lending process. These updates collectively offer a mix of challenges and opportunities for multifamily investors. The increased flexibility and potential for higher leverage are positive developments, but the changes also require careful navigation of the new processes and guidelines. As always, staying informed and adaptable is key for investors aiming to thrive in the evolving real estate landscape. As we turn our focus to Alberta's multifamily real estate market, developers are facing a new reality. According to Damir Jesic, Assistant Vice President of Commercial Financing at First National Financial LP, the market has shifted following a period of significant growth in cities like Calgary and Edmonton. This growth was driven by stable employment, a lack of rental caps, and an influx of migration, particularly as Ontario and British Columbia struggled with affordability. However, the once booming market has now led to an oversupply of multifamily housing in these cities. Vacancy rates are trending upwards, and rental rates have stabilized or softened, especially in Calgary's high-end market. Landlords are working hard to maintain rents, but incentives are becoming more common. In Edmonton, performance varies by submarket, with new suburban projects leasing well, while downtown areas face higher vacancy rates. Developers in Alberta are adapting by rethinking their strategies. Instead of pursuing multiple projects simultaneously, they are focusing on tailoring their strategies to specific assets and reducing turnover. The Canada Mortgage and Housing Corporation, or CMHC, continues to provide crucial financial backing, but rising premiums and credit tightening are impacting development sentiment. The market is expected to stabilize in the medium term, with vacancy rates likely to remain around or above the 5% mark, and rental rates staying muted until 2026 or 2027. This softening could alleviate rent pressures for Alberta residents, who have faced strong demand over the past few years. The focus is increasingly on cost, as consumers prioritize affordability. At First National, developers and investors are navigating this market shift with a variety of financial strategies. Conventional financing for construction is being sought more frequently, while CMHC remains a key player for permanent financing. Developers are becoming more cautious during the design and development phases, aiming to build with potentially less leverage. Opportunities still exist, as construction costs stabilize, and Calgary and Edmonton remain comparatively affordable. High-quality locations with amenities and walkability are still in demand. As the market evolves, developers are adjusting with new financing, design, and construction strategies for Alberta's growing multifamily landscape. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.